I would say just before I kick off, in terms of general rule, although I'm based in Scotland, it's the exact same rules that apply to England. So if you're based in England, it's going to be very, very similar in terms of appetite, loan to value, rates, terms and conditions, etc. So consistent across the board.
Where are you based, Fergus?
I'm in Northern Ireland.
In Northern Ireland. Is that okay, Graeme?
Yeah, absolutely fine. Got a few lenders in Northern Ireland that have appetite for those types of projects, so wouldn't be a problem.
Good stuff.
Is it just construction that you get involved in, Graeme? Would you do all sorts of different things?
I would say that our core business is property related, although we're looking at offering more of a holistic service. So obviously, property is very important to that. So yeah, we support a lot of construction businesses with their own projects, their own from ground up or refurbishment projects. But we also support with, working capital, business finance, property finance, as I've just discussed there, but also asset finance as well. So there's really nothing that's off the table.
Okay.
Excellent. So there's Mr. Gibson, Mr. G. Gibson, just joining us. I'm going to have a stab at that. G for Jim?
Jonathan.
Okay, I was nearly right.
Nah.
Jonathan, you just want to introduce yourself, tell us who you are, where you're based, and what kind of financial interest you might have either now or in the near future.
Yeah, so I'm Jay Gibson. We run a small to medium-sized building company. I've been trading since 2002. We've got sort of 6 full-time employees, number of subcontractors on the cards, and we're just on to see what this is all about. We want to see the money. Show me the money.
Yeah.
Excellent. Okay. I like it. I like your enthusiasm.
Good man.
Fantastic. Right, will we kick off then?
Yeah, why not? Well, thanks, Stuart, for this opportunity, and thanks for joining us tonight, guys. Obviously, beautiful weather at the moment, so thanks for making the effort to stop by. So, bit of background on myself. I've always worked in business-to-business roles throughout my career. Latterly, I worked for a government economic development agency, so always working with scaling businesses and helping them to grow their business. So working with ambitious people. So before I took the plunge, I've always been getting to know business owners, what their plans are, their ambitions. And one thing that was always, a bit of a frustration for them was, sourcing commercial finance, whether that's for property investment or, business purposes. It was always an issue. Okay. Beyond speaking to their own bank, clients were really, unsure as to who to turn to for, sound, objective advice and guidance, especially when it comes to, say, more speculative cases, especially within the construction industry, developments, etc. I would say that the high street, probably doesn't have as much appetite as other specialist lenders do for this type of these types of cases. So about 3 years ago, I decided to take the plunge, started my own business, and we started Pathway Commercial Finance. We were looking to solve those problems for property developers, property investors, and businesses. So I'm running my own business. I'm also a property investor with a portfolio myself. So I feel really passionate about, helping people like yourselves to build wealth, to grow businesses, and to create more passive income. So that's a kind of bit of background on me and, what we're doing and who we're trying to help. And I think just based on, some of the feedback I've had, on the call, I think, you're definitely in the right place. You're the type of people that we are looking to help as a business. definitely.
Excellent, Graeme. Fantastic. Okay, in that case, we'll go straight into question number one. And just the benefit for everybody on the call and those that are maybe just joining later and watching the recording, just along the bottom there, I've got Graeme's contact details. So it's Graeme@pathwaycommercialfinance.co.uk. And I just wonder if you could have got a longer email address there, Graeme. Maybe work on that. Pathway Commercial Finance, Highlands and Islands, Scotland Limited, but also cover the UK.co.uk. So that's Graeme Schmidt, Graeme@pathwaycommercialfinance.co.uk. Graeme, question number one. There's a lot going on in business right now. In case you haven't noticed, we've got inflation, cost of living, a recession, no recession, depends which political party you affiliate to. Can you tell us what the general appetite is? And I know there's how long's a bit of string, but what's the general appetite for lenders at the moment?
No, it's a good question, Stuart. Obviously, a lot going on at the moment, a lot of volatility. The last, 3-4 years, it's just been relentless. So that's obviously had an effect on the cost of money. It's had an effect on appetite. But I would say, generally speaking, there's still plenty of appetite out there. Okay. I would caveat that by saying it really depends, on which lenders you're speaking to and, what project you're looking to fund. So I would say the thing to remember from this webinar is that just because your bank doesn't want to do the deal doesn't mean that it can't be done. Okay.
Good point.
Lending is very, very specific to you, the client, and your circumstances. So I would say if we're just going to, give a bit of context, in terms of, the cost of money, yeah, cards on the table, it's definitely more expensive than it was, say, 12 months ago. And the Bank of England base rate is 4.5% just now. Okay, so again, in terms of context, the last probably 14 years, we've been running at a Bank of England base rate of 0.25%. And in March of 2020, it was 0.1%. So gives you an idea of where we are. I mean, there's been huge increases. And normally what will happen is lenders will build in a margin over and above the Bank of England base rate. So like no getting away from it at the moment, money is probably more expensive than it's been in the last 14 years. But it's not all doom and gloom because there is some good news as well. So over those last 14 years, we've seen a huge increase in the number of lenders that are out there that have appetite to lend to people like you, to ambitious people, developers that are looking to do maybe more speculative cases. So I would say that that's probably one of the main advantages of working with a broker like myself or like us as a business, because we're not just, working with your high street. So you'll recognise the high street, you'll recognise, all those names, NatWest, Lloyds, HSBC. You've probably got 10, core lenders out there, and, their appetite, hasn't been fantastic for this particular industry for quite a while now. So I would say that what we can do is we can plug you into those, additional lenders that are coming to the table now. So, amazingly, there's probably about 300 lenders out there that we are speaking to, regularly. Now, don't get me wrong, you're not going to see terms from all 300 of them, but they all cater for a certain niche. Okay, so you'll have your lenders that are very good at, say, bridging finance or short-term finance. You'll have your lenders that are very good at invoice finance, development finance. The list goes on, but they all very much focus on, one particular area. So they're specialising versus your more traditional banks and lenders that are more, general. So I would say that, in terms of appetite now, nothing is off the table. And obviously, it has to stack up. The numbers have to stack up. But the lenders now that are specialising in these niche areas, they're not as prohibitive in terms of, their criteria, their requirements. And I'll give you an example, and I don't know, maybe Stuart's mentioned it already, but This gives you a good flavour for what can be done. So it was this time last year, actually, just off the west coast of Scotland. There was an island up for sale. Okay, now you can imagine, none of the high street lenders were keen on it. But with a really strong proposal, good, strong rationale and forecasting, we were actually able to get a lender to lend on that case. And it was 60% loan to value on an island. That at that point was, basically there was nothing on it except a lighthouse. But the clients I was working with had experience in the hospitality sector and obviously had, a really strong business plan, which we helped them with. And we were able to get, a lender on board to do that deal. So I suppose it gives you a flavour for what can be done with the right positioning.
No, that's brilliant, Graeme. So just for the benefit of Darren and Tom that joined us there is, although the rates are more expensive, obviously, there is definitely a good appetite. In fact, if not a much better appetite for lenders at the moment, which is absolutely brilliant. And I just love that story with the island. Fantastic. You can finance an island. Okay, moving on to the next question, Graeme.
Yeah, and you've got.
So a lot of people on the. Sorry, carry on.
I was going to say, if you can finance an island, you can literally finance anything. That's that's where we are.
Yeah, we'll hold you to that. So a lot of people here, Graeme, may be looking for asset purchases and leases as well in the coming months or years. What deals are there to be had? What are the rates like? And I think a good question here that a lot of people would be interested in is what's sensible for deposits. Is 100% lending still there? Or if you're going for assets and leases, is there a sizable deposit needed?
Yeah, so I think I've mentioned this already that lending is specific to you, it's specific to your business in terms of affordability. And the way I always frame asset finance is that as your business evolves and grows, the types of lenders that you're able to access will also evolve as well. So if you're a relatively new business or a startup or don't have much track record, you are going to be dealing with certain types of lenders that have appetite for clients in that space. So probably more kind of tertiary lending. And as your business starts to evolve and grow, and you have a stronger, say, balance sheet, you've got stronger profitability, you've been trading for longer and have more of a history, then you're going to find that the access you have to different lenders with, say, lower rates will change. And so in terms of rates, I'm not going to speak specifically about rates at the moment, but what I will do is I'll give you some general rules. And I suppose if you've had asset finance in the past, you may well know this, but we're probably looking at between 5 and 10% deposit as a minimum. So there has to be usually some skin in the game. And many lenders will let you defer your VAT as well and add that to the loan. And I suppose it's all predicated on the business having the necessary cash flow or affordability. It's what they call, you'll probably hear this term, it's called debt service cover. So providing you have that within your business, then there are plenty of lenders with appetite for strong hard assets, so machinery, plant, vehicles. It's going to have some sort of resale value, because that's really what underpins and ensures their security. So I would say, yeah, asset finance, it's a fantastic way of ring fencing those funds so that you can put them to good use in other ways, in terms of generating cash flow. And you mentioned there are any good deals out there. I suppose it's all relative. I mean, the way I look at a good deal really is, whatever you're looking to invest in, it has to give you a greater return than the cost of the money. So, you're looking at opportunity cost. What could you not do unless you have that asset? And what value can that asset bring to the table? So, in terms of deals, yeah, there's always deals out there, but they're really dependent on, you know, what your plans are for that particular asset, I would say.
Makes sense, Graeme. Thanks for that. And just a reminder to everybody, Graeme's details are on the bottom of that slide, graeme@pathwaycommercialfinance.co.uk. Right, we'll move on now to question number 3. So, what about businesses that are looking to raise cash, Graeme? I've come across this quite a lot and fairly recently. You'll probably remember a few of these cases. Businesses that are looking to raise cash, what options are available, such as maybe refinancing assets that we've already got, perhaps? So what options are there for refinancing, or maybe bridging loans, or even just loans for cash flow? What's your thoughts on that kind of process?
Yeah, so I would say, with regards to this question, you probably hit the nail on the head there. I mean, there's two ways of doing this, I suppose. So lenders, they like security, they like assets. Okay, so they want to secure against assets that you own, or they want to secure against assets that you're looking to purchase. Now, there are lenders out there that will also look at unsecured lending. I would say within the construction industry, I would say there's less appetite for it. And even if you have a very, very profitable business, because of the volatility of the sector, it's very difficult to get lenders on board from an unsecured perspective within the construction industry. I was trying to place a case recently, and it was a construction firm, £4 million turnover, net profit of around about £200,000, £300,000. You know, a successful business, doing very well. There was absolutely no appetite at all for unsecured lending, and what little appetite there was, it wasn't even worth sharing with the client, because the amount of lending that they were making available was laughable, if I'm being honest. And the rates were sky high. So don't want to put a damper on, you know, unsecured within the industry. But I think, you know, if you're going to raise funds, it's probably going to be down the secured route. So typically it's secured against a tangible asset, let's say bricks and mortar, as an example, that you currently own. It might be unencumbered, it might not have a mortgage on it, so it might not have any debt against it, and you might want to, say, raise finance against that. Or you're looking to maybe invest in either in a residential property, we spoke about them earlier on, buy-to-let, HMO, serviced accommodation, or it may well be, you know, other tangible assets that you're looking to buy. So, you know, we're looking at residential investment property, we're looking at commercial property, land as well, or even your own home, if need be, for business purposes. So not going to get into the technical side of it too much today, but you've got your first charge and you've also got second charges. So lenders will have appetite to lend against property, especially that has no debt against it. And we're looking at, you know, maximum loan to value of, say, 75%, maybe higher on residential, probably 65 to 70 maximum on commercial. Again, depends on the nature of the client. I'm doing a deal just now for a client who's buying the premises they're renting, and because they've got a really strong business, we were able to increase the loan to value to 75% on the commercial premises. But that's very much, you know, out with policy, and that took a lot of, you know, negotiation on my part as well. So if you're in business and say you've got, you know, a home that doesn't have a mortgage on it, I know some people say, look, that's not up for grabs, but, you know, if it's something you're doing and you know you're going to get the returns on it, then there are lenders that will look at first and second charge. So even if you've got a mortgage on your property, but say you have, you know, quite a nice amount of equity there, they'll actually be able to leverage that. So you could potentially look at raising funds that way. Now, we've obviously spoken about asset finance, you know, plant, vehicles, machinery. they're always, a good fit, for lenders. We're looking at up to, 80% there, sometimes higher in terms of, releasing funds. But the last thing as well, I mean, moving away from, those kind of tangible assets, it might well be that there's, a debtor book that we can look to maybe exploit and leverage as well. So if you've got, say, a lot of unpaid invoices, then that, if it's business to business, that is, from really, strong debtors, then potentially that's another way to leverage, debt or lenders' funds. So, general rule of thumb, I mean, it's between 50 and 90% loan to value on these assets, and there's short-term solutions, there's medium term, there's long term. I think that's where we're looking to really understand the business. What your ambitions are, what your plans are, and then what we do is we build a solution around that. I mean, excuse me, if you need the money fast, you're probably not going to engage with a high street lender to get a commercial mortgage, because you're going to be waiting, say, 3 or 4 months, maybe longer. At that point, you're looking at specific type of finance that might cost you a wee bit more because it's risk versus reward, but you get the deal done quickly. And I think that's always the key. It's not always about the cheapest rates on the market, because the cheapest rates out there will be with, say, Barclays, for example, or TSB. But I've got cases that I've been working on that have been rumbling on for 6, 7, 8, 9 months with those lenders. There's just no urgency to get deals done quickly, and it's all about doing a lot of analysis and drilling really deep into the case. Whereas other lenders, they're in business to fill that gap where if you need fast finance, or if your business doesn't tick every box, they're still keen to lend. But obviously, it's risk versus reward, and you pay a bit more for it.
Graeme, here's a quick question. What is the typical kind of maximum length of a commercial mortgage?
So a commercial mortgage, it depends. I mean, if you're buying it as an owner occupier, say you're buying it to operate from, then it depends what sector you're in. Now we're obviously in the room today. We've got construction, so I would say if you've got a really strong business with strong profitability, then it may well be that we can potentially look at 75% loan to value on commercial property investments if you're going to be operating from those premises.
And over what period, Graeme? Over what period could that be taken over?
Well, a mortgage, it depends what age you are, but I mean, if you're under the age of 45, then we'd be looking at between 20 to 25 years. There's actually some lenders that will go up to 30 years. So that's the beauty of mortgages, in the sense that you can profile it over 30 years. Okay, so it really reduces your monthly outgoings, versus, say, asset finance, which is normally 6 or 7 years. If you're profiling a large amount of money over 30 years, then it really reduces, the impact it's going to have on your monthly outgoings and cash flow.
Brilliant. Okay, we'll move on to question 4. So again, just take a note of Graeme's email address, graeme@pathwaycommercialfinance.co.uk, and take notes, guys, because we'll allocate some time at the end. So if you've got any questions, you can fire them at Graeme. So without further ado, we'll go on to question number 4. So there's a lot of developers. We already spoke to a few before we started. Walk us through how you go about securing development finance or funding maybe some buy to flips, bearing in mind that these guys are in pole position to perhaps buy rundown, maybe not certainly derelict properties, but certainly rundown properties at auctions. Talk us through how finance could be available for those type of projects.
Yeah, there's lots of lenders out there now that have appetite for these types of cases, because property is seen as a really strong asset class. So there is still a huge number of lenders out there that will do these deals, and we'll talk about the model that a lot of my clients are using to, you know, accelerate their progress in this space. So there's a lot of crossover between development finance and say, or developments, and obviously getting your hands on and securing development finance, and also say, you know, buy to flip, or, you know, buying, refurbishing, refinance, and then, you know, recycling that cash again, you know, and looking to grow a portfolio. So what I'm going to do just now is I'm just going to kind of break it down for you. So this is where I would focus my energy if I was you. So if I was in your position, you know, maybe I've not done any developments, maybe I'm doing one or two, you know, and you're building up that track record, or maybe you've got a, you know, strong business, and you've got, you know, track record as a contractor, for example. I mean, that is all, you know, valuable in the sense that, you know, lenders like to see that, you know. So I would say that the two areas I would focus my energy would be, you know, track record, definitely track record, because lenders like to know that their money's in good hands, their money's with experienced operators, but also, you know, property or development due diligence. Okay, so generally speaking, the more experience you have, the more appetite a lender will have to fund the project. Okay, now don't get me wrong, there are lenders out there that are quite happy to work with, you know, first time investors, so first time developers, first time investors, and say buy to flip or buy to hold. I would say that, you know, if you don't have experience of, say, even a buy to flip at the moment, then what you want to do is you want to be focusing on where your experience does lie. So what other projects have you worked on that are going to get lenders on board that you know what you're doing? And if you haven't done anything at all, it doesn't sound like there's anybody in the room that hasn't done anything, but if you haven't done anything, then it's more looking at, well, who can you partner up with to fill those gaps? Because the key here is really getting the lender comfortable with you, and you know what you're doing, or your team around you knows what you're doing. So
Good point.
track record, you know, that's where I would start. So always make sure if you are working on something, you're taking photos of before, you're taking photos of after, and then you want to give some commentary, you know, on what you've been doing as well, and what was the outcome. So tell us more about, you know, the projects you've worked on, the projects you're working on now. You know, how were they managed? Did you manage them yourself? Did you maybe bring in a project manager to do it for you? Did you outsource it? You know, how did it all work in terms of the dynamic? Were they successful? Were they profitable? You know, tell us more about the properties that you developed, or the properties that you've refurbished. You know, you want to really drill into that detail, and you effectively want to, you know, have a CV, you know, to present to lenders as part of your proposal. Now, that's obviously something I can help you with, or we can help you with, in terms of, you know, how you structure it. But that's something you can get started on now. You know, it's start thinking like a lender. You know, if you were going to lend your money to somebody, then what would you want to see? And you'd want to see track record, wouldn't you? You'd want to see what they've done in the past. So that's where I would start. And then moving on from, you know, track record and CV and whatnot, and an overview of what you've done in the past, it's really, you know, let's see the due diligence that you've done on this particular project. Have you worked out your costs? Have you worked how long you need to build? Have you worked out how long you need to sell the property? Do you have a build schedule? You know, have you provided that commentary and rationale that kind of underpins, you know, why you're doing this, the kind of story behind the numbers as such? And what you also want to make sure is that, you know, you've got a real handle on the GDV. Okay, so the gross development value of the properties that you're building, or the property that you're refurbishing. You want to try and find similar properties that have sold locally. You might want to even engage with a local estate agent to get feedback on saleability. you know, you're covering as many bases as you possibly can. And then with buy to flip, you know, as I say, there's a lot of crossover. However, there's probably more appetite for your first time investor or first time, you know, developer to do that, because at that point you're kind of earning your stripes, aren't you? You know, you're working on something maybe smaller, and then you're working your way up, you're building up to, you know, bigger developments with you know, larger amounts of lending or borrowing.
Brilliant. Okay, a lot of good advice there, Graeme. A lot of stuff there I never really thought about. But yeah, of course, it makes perfect sense. You know, if you're asking for people to part with a large amount of cash, then they're almost going to want a CV, a breakdown. So yeah, absolutely brilliant advice there. Okay, we will move on to question number 5. So we'll get a bit of realism into it now. So being realistic, what do businesses need to have in terms of plans, business plans, cash flow, deposits for funding? You know, what are lenders looking for? And in particular, Graeme, what pisses them off? You know, what's going to get a lender pushing back?
Yeah, I mean, it's a good question. I think that's one of the reasons that you would work with a broker in terms of that quality control. So when you're answering lender questions, to a certain extent, you know, some of them are trick questions. I suppose you really need to know your audience and you know, what they want to hear more of, what they want to hear less of, and that's the job of the broker. It's that understanding of where the appetite lies and how to frame a case and how to sell a case, you know, in terms of the proposal that we are writing on behalf of our clients. So yeah, it really depends on the nature of the case. I mean, I'm more focusing on, with this particular question you've asked me, I think, you know, we'll make this more specific to the construction industry and development finance. So again, yeah, there needs to be some sort of plan in place, and you know, you always start with your breakdown of costs, you know, your build schedule, and then just getting your due diligence and research correct and accurate. That's really important, because that's the first sight that the lenders had of this particular case. So yes, you know, we would work with you to make sure that it's watertight. We don't want to take anything to lenders that's half-baked, you know, because that can kill a case. And I've spoken to clients in the past that have maybe gone to lenders prior to speaking with us, and it's probably lenders that will have appetite for the case, but because of the way they're framing their answers, the deal is not happening because of that. But we can kind of repackage it, reframe it, and actually on occasion, you know, we've managed to breathe life back into the case. So first and foremost, from a development lending perspective, it's really, you know, I've mentioned track record. Well, you know, you need to have a solvent business, because that's you proving, you know, you're proving and stress testing that you know what you're doing. So the business that you're currently running, you know, is it solvent? Is it making money? Does it have, you know, a good, strong track record and history? And beyond that, how are you managing your own personal and business finances? Because you really need to be operating within your means and managing your own money well. And you don't want to have, you know, lots of credit card debt or missed payments on, you know, leases, for example, for cars or mortgages. You know, this is all, you know, part of the assessment that lenders will do. So it's very much like getting your own house in order prior to going to lenders. And again, it's something we can help with in terms of getting your lender ready. So they want to see that gradual, steady growth over time, strong assets or balance sheet, and you know, you're building that up, you know, over a number of years. It's not, you know, feast or famine or boom or bust. It's nice gradual growth over the last, say, 3, 4, 5 years. And that really
you used a great phrase there, Graeme, getting you lender ready. You know, that's an interesting one. That's, you know, for the people on the call and for the benefit for people listening to the recording, you know, for me, that's the big takeaway. Speaking to somebody like yourself to get them lender ready, because that, you know, that'll probably answer the last question of what really annoys them. But you'll make sure that you cover all that by getting them lender ready. I would imagine, Graeme, that with many lenders, you'll maybe just get one bite of the cherry. So coming to you, you know, dotting the I's, crossing the T's, and then going for funding application, to me makes perfect sense. So like that phrase.
Well, that's exactly
Move
it.
on to, yeah,
Okay,
perfect.
we're up against time here, are we? So, okay.
No, we're fine.
No, I was just going
Just to give time for questions as well.
give the guys a bit of an idea, you know, as to, you know, rates and whatnot for development finance. So, just a bit of, you know, more information on the numbers, because I suppose that's important. So, you know, when you are crunching the numbers, you probably want to be looking at a maximum of 80% loan to cost, and say 60 to 65% loan to GDV, maybe a bit higher depending on the nature of the lender, the nature of the case, and rates of between, say, 0.95% and say 1.5% per month, depending on the kind of variables within the deal. So I'm doing quite a few of these types of cases. You know, the bigger, well, I suppose it's all relative, but you know, we're talking maybe 10 to 20 properties at the moment. You know, 2, 3, 4 million pounds of lending required, and that's the kind of numbers we're looking at. You know, and we can help you understand that, because you're going to have, you know, different ways of structuring it in terms of, you know, how the rates are actually serviced, but also there's going to be, you know, arrangement fees potentially, maybe an exit fee, and other costs associated with this type of finance. But what we can do is, and you know, we can map it all out for you and get you more than one option. So, you know, it's putting quite a few of those options on the table, and then between us, we decide which way we want to go and which option we want to pursue. So you will need some skin in the game, though. I mean, yeah, there might be a few lenders out there that will do, you know, a JV to a certain extent. It's 100% funded, but, you know, they're obviously far more difficult than other lenders that expect you to have some skin in the game. So rule of thumb, we're probably looking at between 40 and 50% of the cost of the land. And then you're going to need to get to that first phase of the build. So it might be 75k of spend, it might be 100k of spend, and then that's normally reimbursed. But, you know, that's quite a crude way of looking at it. You know, it's more complicated than that, more complex, but, you know, that's something that we discuss, you know, as we move, you know, through the various stages of getting closer to the funding. And I don't want to kind of bog you down with that at the moment, really.
No, that's fine. That's a good insight. So final question for this evening. I know buy-to-lets is a passion of yours, Graeme. So people on the call, and for the benefit of people on the recording, listen to the recording, how can you help people prepare for starting or perhaps expanding a property portfolio?
Well, yeah, as you say, I mean, I'm a keen investor myself. I've got, you know, my own portfolio of properties, so really, you know, practicing what I preach in that sense. And I think at the moment, you know, buy to let, it's probably had its day, to be fair, you know, in terms of buying, refurbishing and then refinancing, unless you're finding, you know, bargains, you know, you're finding them below market value and they're high yielding, or there's scope to add value, really. So because the Bank of England base rate's higher than it once was, you know, it's harder to find those properties that are providing the necessary cash flow, really. And for me, you know, it's all about how quickly you get your money out the deal again. You know, so if you're buying a buy to let and it doesn't stack up because the rent's only, say, £500 or £600 a month, and, you know, it's going to cost you £150,000 to buy, you're probably only going to get a loan to value of say 50 or 60%. You're probably going to see a margin of next to nothing every month in terms of cash flow. So I get the impression that's not the type of properties or investments that, you know, the people on the call are looking for. So probably not looking to park your money long term and have it just sitting there. You'd be more inclined to want to put your money to work, to want to get it back out as soon as possible, and then go again and actually start building, you know, a portfolio and have a more aggressive growth strategy. So I would say if you're looking to do that, then it is looking for the value add. So, you know, are you looking at, say, commercial to resi conversions? Are you maybe looking at adding value through refiguring properties, you know, adding rooms, for example, or maybe just looking to improve the cosmetics of the property to add value? So the model that a lot of my clients are using, and they've been, you know, very successful over the last, you know, few years, is, you know, taking advantage of short-term finance. So you're buying a property that needs a bit of work, okay, or you know you can add value to. You're using shorter-term finance. We're getting the deal done quickly, and actually, in some occasions, the lenders will also let you borrow money for the actual refurbishment costs as well. So in terms of loan to values for those types of cases, it can vary anywhere from, say, 75% loan to value up to 85% loan to value. Plus, you might be even able to borrow the money for your refurbishment costs in arrears. Okay, but there's more to it than that in terms of parameters. But that's, you know, what we're looking at. So you know, in terms of those numbers, again, it's, you know, going to vary depending on the type of deal we're looking at. But we're probably looking at between 0.95 and say 1.25% per month on that, either serviced or rolled up, or maybe even deducted. So there's various ways in which we can structure it. But I think in terms of, you know, buy to lets at the moment, probably not getting the returns. So what I'd be focusing on is maybe holiday lets or HMOs, serviced accommodation, or even looking at purchasing portfolios, so 6 or more properties, because at that point you're able to circumnavigate the additional dwelling supplement. So, you know, it's less tax, and at that point, you know, you'd like to think you can find a better yielding portfolio of properties, and we can leverage that. So see if you can find, say, a portfolio of properties below market value, but it has a high yield, then we can look to leverage the market value at the point of purchase as opposed to the purchase price. So you might find some, say, a great deal below market value. It's, say, £400,000, but you know it's worth £500,000 or maybe even £600,000. Now, if it's got what's called affordability within the rental, within the property portfolio, then we can look to leverage that, providing it meets certain debt service cover requirements. And don't worry about, you know, all this different terminology. It's something I would look to help you with and explain, and you know, make things a bit easier for you. But if there's deals out there that you're finding, then, you know, by and large, there's still lender appetite out there to leverage them. And so, yeah, nothing's off the table in that sense.
Excellent. Nothing's off the table. Fantastic. Okay, just conscious of time. We're doing okay. So, Graeme, here's a statement we're going to look to finish up with. Okay, Graeme, complete the phrase. Mainstream lenders are.
Well, I mean, I don't want to speak too disparagingly of them, because I mean, I do a lot of deals with the mainstream lenders, don't get me wrong, but, you know, I think from a development perspective, or maybe in terms of the more speculative cases, they certainly are more risk averse. That's what I find.
Okay.
You know? So there's no point in taking them a case and it doesn't stack up, but I know what they're looking for. You know, I know how they assess cases. So I don't waste their time and I don't waste my time or the client's time by promising them, you know, high street lender rates. So I suppose for me, yeah, risk averse.
Mainstream lenders are risk averse. Fantastic. Okay. So that was Meet the Expert. You've got Graeme's contact info below. Graeme Schmidt, Graeme at pathwaycommercialfinance.co.uk. Next month, July the 11th, we have John Straw joining us. John's a renowned global expert on AI, artificial intelligence. He's an advisor to the Scottish Government, he's an advisor to BP on AI. He knows his shit. He's going to scare us shitless by outlining how Terminator is actually a documentary, such as the pace of AI. So that's 11th of July. Be sure to join us. So back to Graeme. We'll move over to some questions now, Graeme, because I would imagine there'll be quite a few people have got some questions. So let's go and open up and see who's got any questions for Graeme. Questions, anybody? Put your hand up or just shout out or just put even in the chat box. Anybody got any questions, or has Graeme pretty much covered everything that you need to know?
How do your things work within it all? What is your role? You, as a broker, you're a broker in the deals that go on. Your fee, how do your fees relate to the deals that go on?
It's a really good question, actually. In terms of how we work, it's very much outcome based. So it's based on us hitting the objective that we agree upon at the beginning of, you know, us engaging and looking to move a deal forward. So it's normally a percentage of the amount of money you're looking to borrow. So I'll put a number out there. It's normally around about 1% that we would request from our clients when we're looking to do a deal, but that's at the point of completion. So when we start working with each other and, you know, we're looking at, you know, say a case that has, you know, a lot of moving parts and there's going to be a lot of time that we have to commit. We want to be able to commit that for you and ring fence it. So what we'll normally say is, well, this is exactly what we're going to have to do for you to make this work. And you can imagine, you know, from start to finish, if we are managing all the different variables, you know, we're making sure that we're speaking to the right lenders, we're selling the proposition, we're writing a really strong proposal, we're coaching you every step of the way. We're then liaising with all the different intermediaries. So you might have, say, valuers, you'll have the lender, accountants, you'll have solicitors. So we're pulling it all together and trying to hide the wiring as best we can. So, you know, you can continue with core business. And, you know, we want to take the stress away from you. So you can plug us into your business. And at that point, at the beginning of the case, what we'll normally ask for is what's called an onboarding fee. Okay, and we'll deduct that from the arrangement fee at the point of completion. So normally it's, you know, it depends on the nature of the case, Jonathan. So very much specific to that. But if it's an off-the-shelf, say, bridging case, and, you know, it's going to get, the deal's going to get done in, you know, 4 to 6 weeks, that's different from, say, a £5 million development, for example. You know, and there's always flexibility. So not to create a rod from my own back, but I think when you've been working with someone for a long time, you've established that trust and you're working long term with somebody, then, you know, you don't want to squeeze every kind of nickel and dime out of them. So the way I work is that, you know, once we've done 2 or 3 cases together, I don't want it to cost my clients anything. So I'm doing deals just now for my clients that I work with long term. And the way I frame it is, you know, you can go direct to the lender and it's not going to cost you any less than it would be to work with me and get all the value add that we're bringing to the table. But that's after, say, 4 or 5 cases. there is a small cost associated, but I would say that in terms of the value, it definitely outweighs, the cost. Does that
Okay,
answer the question?
excellent.
Jonathan?
Yeah.
Any
absolutely.
more questions? You happy with that, Jonathan?
Yeah.
Any more questions for Graeme?
Can I ask a question? It might be not related, but we're looking to bring a new product out to market. I'm just wondering what finance is available for launching new products to bring them into the construction industry stream, and what would we need to have in place to be lender ready?
Yeah, that's a good question. That's an interesting one, actually. So, there is going to be funding out there, but I suppose it depends on the nature of the business that you're currently running, and whether or not there's scope maybe to leverage that as opposed to the new product that you're looking to introduce to the market. Maybe retrospectively, there will be, say, funding that you can look to take advantage of, maybe potentially, R&D tax credits, for example. But I would say if you're looking to bring a new product to the market, then we're probably looking at how do we leverage what you have in terms of track record, in terms of assets, and then maybe in terms of, what you need to develop that product, what machinery might you need to move that forward and progress it, because at that point, there's probably asset finance that we could look to help you with. In terms of getting you lender ready, what we would do is we just look to kind of tidy up, you and your business and how it all looks from a lender perspective. So we'd start with an assets and liability statement, income and expenditure. We want to see your accounts, obviously. We want to know that you've got a strong credit profile as well. We're going to bring that all together, and then we package that for lenders. And if there are any, say, bumps that we need to, or maybe elements we need to try to smooth over and iron out, it's providing that mitigation, really. But there's 101 things, I suppose, that you need to focus on. But I suppose what we're trying to do is just make sure that we streamline that for you and make it easy.
What if we're looking to launch this product under a completely new company?
So the way, again, it's the way I would look at that one would be the underpinning company that you're running at the moment. It's probably, again, looking at leveraging that. It's very difficult to leverage projections and forecasts for something that's new to market, because it's the unknown. So lenders like security, they like assets, they like historical data, and there may well be, say, government funding that might be out there that you can access for that type of project. But I would say, in my experience, it's far more difficult to get your hands on that type of finance for something that's maybe innovative and not tried and tested. So I think where I would start is I'd probably start by engaging with maybe local authority or maybe your the government initially, to say that this is what you're looking to do. Because I know, and don't get me wrong, I'm not an expert in all the local support south of the border, but I know where we are, because I used to work for one, Highlands and Islands Enterprise. They have those types of funds for these types of projects, and that's where I would be going. So I have probably one or two lenders that I can introduce you to that work in that space in England, and maybe they'd be a good fit for it because they're government backed and they're able to take a punt on maybe more speculative projects that your mainstream private sector lenders wouldn't. So happy to get you those details, and hopefully you can move that one forward.
Fantastic.
Brilliant.
Thank you.
Okay, so that's us just hitting 7 o'clock just now, so perfect timing. any other questions for Graeme, or will we wrap up at that? Everybody happy? So Graeme at pathwaycommercialfinance.co.uk. If you've got any questions specific to Graeme, maybe you don't want to share it in the group, which is totally understandable. Finance and financial matters is always a bit of an emotive topic. So please reach out to Graeme. I'm sure he'll help and answer as best he can. So we'll wrap up at that. So huge thanks to Graeme. That's been pretty insightful, Graeme. You covered a heck of a lot there in that hour. So thanks for that. Hope the guys in the call found that helpful, and those watching the recording find that equally helpful as well. So that's Graeme, pathwaycommercialfinance.co.uk, the guy that finances islands and everything in between. Excellent, Graeme.
Thanks, guys. That's fantastic, and enjoy the rest of your evening. Thank you.
Yeah, mate. Thank you.
Thanks very much, Graeme.
Graeme.
Appreciate that. Really good. Oh, hang on 2 seconds. There's just a couple of chats. Somebody said, yeah, what's the email? It's Graeme, Graeme, Graeme at pathwaycommercialfinance.co.uk. Graeme just put it into the chat there, which is
That's my
fantastic.
email. There's my mobile phone number as well if you want to, even just discuss cases you're thinking about potentially moving forward. I'm happy to help and give you a steer, so you're not, wasting your time on anything. Okay.
Excellent. So Graeme's just put that number in there. Just take a quick note before we shut down. So yeah, thanks for that, Darren. Excellent. Innovative finance. I love it.
Yeah.
Great. Okay. Thanks very much, guys. Really appreciate that. It was a good effort tonight. It's always challenging to get people to come along when it's such a hot and pleasant evening when cold beer awaits. But thanks for that. And is that a cold beer you've got there, Graeme? Is that water?
Not quite. Vodka.
Vodka.
Kidding.
Excellent. Okay, guys. Again, thanks very much. Really enjoyed that. Graeme, that was awesome. Thanks very much.
Thanks, guys. See you later. Bye-bye.
Cheers for that.
Okay, bye-bye now. Thanks, guys.
Bye-bye.
Bye-bye. Bye-bye.